Aloha. Welcome to Abe Seminars sessions. Today, our topic is mortgages. We talked about mortgages a little bit in our last session, but we're going to go into more detail about the players in the mortgage industry. Nearly all real estate transactions involve some sort of financing. Unless you're rich and you have cash, then you probably won't need a lender. But in Hawaii, about 60% of real estate transactions require a lender and a borrower. So about 40% of the transactions in Hawaii are with cash. Can you believe that? Four out of 10 buyers are cash buyers. 6 out of 10 require some sort of financing. So the parties to a mortgage are what we call the mortgagor. And a lot of people think the mortgagor is a bank, but that's not true. The mortgagor is a borrower, and the mortgagee is a lender. So how did they get these names? So if you borrow money from a bank, the bank is going to loan you money so you can buy the house. The bank wants some collateral. They want some credit or something to pledge the property or the loan so that in the event there's a foreclosure, that the bank is going to foreclose on the property and sell the property at, say, a foreclosure auction. And then the sale proceeds will pay off the bank. So the borrower is giving the mortgage to the bank. So the giver of the mortgage is called the mortgagor. Well, that's kind of confusing. So I rather call them the borrower instead of the mortgagor. The bank is receiving the mortgage. So the receiver is the E. So they're the mortgagee. So now the mortgagor is the borrower and the mortgagee is the lender that's loaning the money to buy the house. Hope that makes sense. After the mortgagee or the lender makes a commitment to make the loan, the mortgagor or the borrower is required to sign a mortgage and a promissory note. Well, how come we have two documents? One, the mortgage document is the pledge to hypothecate the property to the bank in the event of a default. So the promissory note makes the mortgagor or the borrower personally liable in case the mortgage proceeds don't cover the mortgage. Example, let's say you bought the property for $600,000 and you put $50,000 down and you borrow $550,000. The market prices go down and the borrower cannot make the payments. The bank foreclosed on the property and sold at a foreclosure auction. And it's sold for $500,000. Well, the bank is owed $550,000 and the borrower is short $50,000. The promissory note is a personal guarantee that says if the mortgage is not covered by the sale of the property, then the promissory note is a personal guarantee that the borrower will make up the difference. That's why you have the mortgage that hypothecates the property to the bank, but also the personal promissory note is a personal guarantee that the borrower will make up the difference in case there's a shortfall from the sale of the property at a foreclosure. So let's say the borrower says, you know what, I can't live in Hawaii anymore. I'm leaving. So they run off to the mainland and they abandon the property. Is the borrower still liable for the mortgage? Yes. Will the bank come after the lender, borrower? Most likely, yes. So you're still obligated to pay for the monthly mortgage payments. And if it sells and there's a shortage, then the bank could go after the debtor or the borrower to make up the difference by way of that promissory note, which is a personal guarantee. The lender usually arrives at how much are we going to lend on this property? So let's take the same example again of $600,000 purchase. The appraisal comes in at $600,000 or higher, so the bank's fine. Because they'll say, okay, the buyer is borrowing $550,000. They put $50,000 down and the purchase price is $600,000. So the bank feels comfortable about that. Let's say the appraisal comes in at $550,000, but the purchase price agreement was $600,000. Well, the bank is not going to loan you $600,000 because the appraisal came in at $550,000. So what happens in that case? Typically what happens The seller could lower the price to $550,000, or the borrower might say, I love this house. We really need to have it. And we'll say, I have extra $50,000 and I'll make up the difference. But the loan will be based on the appraised value at $550,000 and not at the purchase price of $600,000. So we always worry if the appraisal is going to come in at the purchase price or higher. If the purchase price is higher, it doesn't matter. The bank is going to loan on the purchase price agreement agreed upon, which is $600,000. So the time period when the borrower and the buyer and the seller have a contract, it goes into escrow, then the borrower now is concerned that the appraisal will come out to the purchase price contract. If it's at purchase price contract or higher, no problem. But if it's lower, then we have a problem. And then we'll have to negotiate between the buyer and the seller. So the lender will then say, okay, on certain types of loans, they might require nothing down, like VA loans or what they call farmers' home loans, or USDA loans is what they call it now. Okay. FHA programs might only require 3.5% down. So it depends on what kind of loan you're getting that requires how much down payment you need to make the transaction work. A mortgage is commonly paid in installments. And so if you have a 30-year mortgage, you make monthly payments for 30 years. That comes out to 360 payments. That's a lifelong pledge that you're making. So when people buy a house, they're concerned that they may not be able to make the payments over the next 30 years, 360 payments. But the payments must be made, or the bank will call the loan in, and there might be a foreclosure action taken. Hopefully not. There are various types of mortgages, but the most common mortgage is a 30-year fixed rate, what they call self-liquidated amortized loan, where the payments are exactly the same every single month for principal and interest. And the payments fluctuate only because of taxes and insurance that may go up and down. Hope this gives you a little better idea of what's entailed in a mortgage. Aloha.